Good afternoon, everyone. I'm Rana Ravi from Committee on MSME Startup. I would like to welcome our speaker, C.A. Srikant Rathi sir, and our coordinator, C. Rakesh Sharma sir, for today's Pathshala series. Rakesh sir, over to you.
Yeah, thank you, Ravi. First of all, welcome Shrikant sir and all the participants for the today's webinar that is on the bonded manufacturing scheme for MSME. So I welcome all the participants and our speaker today. Just for the introduction for Shrikant sir, I'll take 2 minutes. I hope Gyan sir and Arpit Kabra ji probably would join later on. So we will engage with them whenever they join us. So we first of all we delighted to welcome Shrikant Rathi sir, a highly accomplished chartered accountant and partner at Sharp and Associates, a commerce graduate for Symbiosis College, Pune, and 2011 FCA. He brings over a decade of deep expertise in indirect taxation, foreign trade policy, and special economic zone. So Shrikant sir has worked with leading firms and where he guided a lot of clients. Over 500 clients he has guided so far in terms of import duties and other topics. As a visiting faculty at the prestigious institutions, Vanicom and Yashida Academy also, he conduct a lot of sessions for government officers and industrial professionals. So his thought leadership through seminars and articles has made him trusted voice in the field of taxation. So in today's session, Shrikant will share practical strategies and insight to help business navigate and the complexity of indirect taxation and maximize available benefits in terms of MSME schemes and other benefits. So I hand over the today's webinar to Shrikant sir, please.
So thank you, Rakesh sir. Thank you for this wonderful introduction, and would like to welcome all the participants to this session on bonded manufacturing. This is a series of sessions which the ICA organizes under the ambit of Pathshala. So today's session we will be discussing how the bonded manufacturing scheme is helping MSMEs overcome their working capital challenges, who can register under this scheme, and what are the compliances, and what are the formalities that to be taken care while registering and taking the benefit of the scheme. So the bonded manufacturing scheme is not a new concept. The concept has been in India since 1970s. Only the scheme has been recently revamped to make it more investor friendly, business friendly, in line with this government's overall strategy of increasing the ease of doing business in India. So, like I said, the scheme has been there since 1970s. But earlier, the restrictions and the compliances were too much under the scheme for a normal business unit to register and take the benefits, to gather whatever benefits were there. But in 2019, most of these rigid compliances or conditions were removed to make this scheme industry friendly. Few examples I would give, like earlier there were requirements of bank guarantees. Now this requirement has been done away with, and only a solvency certificate is required. Earlier there were physical supervision of customs authorities. This is also removed. Now everything is on a self-declaration basis. So these kind of changes have been made, but the scheme has already been always been there. But more recently, it is revamped or repackaged as a mover scheme. The name derives from the regulation which brought in the scheme, manufacturing and other operations in warehouse regulations. This is the name of the regulation under which this registration of bonded manufacturing is given. So we'll start with what all we will cover today in today's session. So first is objective. What is the objective of revamping this session, revamping this scheme? What are the advantages of the scheme? Who is eligible to register? How the scheme works? What are the relevant sections, notifications, if you want to deep dive into it? Registration processes, timelines, and the documentation requirement around it. What is the import process? How the import process for a unit operating under bonded manufacturing is different than a normal unit. Then when and how to pay the duties, what are the compliances, and how we can exit from the bonded manufacturing scheme. So we'll start one by one. First, we'll start with what is the objective. So like I explained, the scheme has always been there, but recently in 2019, it was revamped to boost the Make in India campaign. So what exactly the scheme is trying to achieve? So the scheme is designed in such a way to promote the manufacturing in India. Earlier, all the schemes were promoting exports related manufacturing, but this is the only scheme which promotes manufacturing for local consumption, as there is no export obligation on the units which are registering under this scheme. So due to this, the scheme has a very wide base to cover, because any manufacturer in India who is manufacturing goods for local consumption can register and take benefit of this scheme. So what the scheme is offering to the manufacturers is the efficiency by unblocking their working capital. If they register under this scheme, they can import more quantity of raw materials, more advanced machineries if they register under the scheme, as compared to if they don't register under the scheme, because of the benefits offered by the scheme. And by promoting the local value addition and the manufacturing around it, the government is ultimately promoting export, because as long as your manufacturing is becoming competitive in India, your products will ultimately become competitive in the local international market as well. So that was the objective of bringing in this scheme. So what are the relevant sections and notifications? So section 58 and section 65, these are two relevant sections here. There is notification. There is a single notification which 69 by 2019, which layouts what is the scheme, who can register, what are the conditions and everything. There are 1-2 circulars and FAQs issued by the government around the scheme, which clarify in detail how the scheme will actually work, what kind of compliances, document, procedures needs to be followed. So what is the main advantage of the scheme? Why should people register under this scheme? The bonded manufacturing schemes offers primarily the duty deferment benefit. So duty deferment means if you are importing capital goods or raw materials for use in your or consumption in your own factory, you can pay the import duties when the imported goods are leaving your factory. Someone who is not registered under this scheme or a normal manufacturing unit has to clear the goods from the port of customs by paying import duties first. Then only they can bring in the goods to their factory. But if they register their manufacturing factory under bounded manufacturing scheme, they are allowed to pay the duties only when the goods leave their factory. So in a sense, the port of customs is being extended to your factory. So your factory is becoming part of or an extension of Indian port of customs. So this deferment will give you unlimited time or period as long as the goods are in your factory. So let's go by component wise. What kind of goods you bring in your factory and how their duty deferment will work for you, or any MSME. So duty deferment in case of import of capital goods. So if you are bringing in capital goods under this scheme, you need to pay the import duties, corresponding import duties on such capital goods only when these capital goods physically leave your factory. So if you are importing capital goods today for installation in your factory, you will pay duty only after 5 years, 7 years, 10 years, whatever the time period these capital goods will be installed in your factory and are being used in the manufacturing activity. So this substantial period of time, 5, 7, 10 years, you will get to use the amount of duty that you are otherwise required to pay at the port of import without any interest. So someone is importing, say, capital goods worth of rupees 1 crore. So without this scheme, they will have to pay almost 28% duty, IGST, BCD, and cess, all including, at the port of import itself. Then only that capital goods they can bring into their factory, install, and then start manufacturing. So the cost of capital goods will be 1 crore plus 28 lakhs of duty, though they will get this credit of IGST amount, which they can set off against their liability. But as of today, they have to shell out this 28 lakh rupees. But if they register under mower scheme, they need not pay this 20 lakh rupees today, 28 lakh rupees today. The entire amount of 28 lakhs will be payable only when the capital goods are physically removed from the manufacturing unit. It could be 5 years, 10 years, 3 years, whatever is the time being, or whatever is the working life of that capital goods. They can use the 28 lakh rupees of import duty without any interest for that much long period and only pay it when the capital goods are physically removed from the factory. Now, what is the definition of capital goods? There is no definition provided under the Act. So anything which is not a raw material for you or a consumable for you, but installed in your factory and which is helping you in your manufacturing activity, or which in some way assist your manufacturing process, can be called as a capital goods for this. So by not defining capital goods under this regulation, or by not referring to any definition of capital goods, the scheme has kept the scope much wider for any industry. So trucks and vehicles may not be capital goods for a normal manufacturing unit, but they can be capital goods for someone who is running a mining operation or related operations, queries. So by not defining the capital goods, government has given a very wide meaning to it, so that wider base of industry can participate and register under the scheme and import the goods. Further, there is no time limit prescribed, like you can import today and pay duty after 5 years or 6 years. There is no fixed time limit. Whatever is the working life of your capital goods or the machines that you are bringing in, you can avail the duty deferment benefit for that long period. Some machines may have lifespan or duration of 15 years. Some may have only for 5 years, depends on the industry to industry. So that's why there is no fixed restriction of prescription of time limit. So capital goods we understood. The major savings are offered in case of capital goods only. Then there is duty deferment in case of raw material. So if you are bringing in raw material, same treatment will be there. You need not pay duty at the port of import, but you pay duty only when you remove the raw material physically from your factory. So how you will remove the raw material from your factory? By manufacturing the goods, and when you take out the finished goods or finished product from your factory, at that time you will pay the import duty on that raw material. So how do you compute how much duty to be paid on that raw material? So whatever is the quantity of raw material consumed in manufacturing a batch of finished product which is being sold out, that much duty you need to pay proportionately. Again, there is no interest and there is no time limit. So you can import raw material for 12 months at one go only. And as and when you are removing the finished goods and selling the final product in the local market, you can pay the duties. What if you are exporting the product, not selling locally? So in that case, you need not pay the duties as well, import duties. Those duties get automatically remitted. You just have to intimate to the customs that out of so and so quantity we had imported of raw material, so and so is consumed in the manufacturing of export products. These are details of shipping bills and consignments. And therefore, that much duty you need not pay. Whatever quantity is consumed in the local consumption or the domestic sale, only that much duty is required to be paid. So for someone who is bringing in raw material for manufacturing export products, this scheme is allowing upfront exemption from the duties, first by deferring the duties, and later on when the goods are actually exported, converting that deferment into an ultimate exemption. Duty deferment in case of molds, tool, dies, same concept as capital goods. They do qualify as capital goods as long as they are being used in the manufacturing activity. But the only difference between capital goods, normal capital goods, and mold and tools and dies is that you cannot remove your capital goods outside your factory for any purpose other than repairs. But molds and tools and dies, you can send out for job work to your supporting manufacturer as well. So this is the difference. That's why I have put in separate line for molds and tools. So as long as these molds are being used for manufacturing activity in your factory or your supporting manufacturer's factory, you need not pay those import duties on these tools and dies as well. And what duties you can defer under this scheme? So duties include basic custom duty, which is generally 7.5% or 10% or 15%. Social welfare surcharge, which is charged at 10% on the basic custom duty value. IGST, which is generally 18% or 12%. And then anti-dumping duties. Even anti-dumping duties also get deferred under this scheme. So if you are bringing in some machines like laser cutting machines or plastic injection moldings, or some other equipments or raw material which has anti-dumping duties imposed, even those duties also get deferred along with these other import duties. And you need to pay anti-dumping duties or other duties only when you are physically removing the imported goods from your factory. So the key advantage is you get duty deferment. Instead of paying the duty at the port of import, you get that additional time as till the goods are in your factory, you need not pay duty. This is the basic advantages of the scheme. So why this advantage, or why this only advantage is given under this scheme? So why government came out with the scheme, I wanted to explain that. There were industries which require substantial investment in plant and machinery. like semiconductor industry or many other heavy manufacturing. Even on an automobile industry or manufacturing of car requires a lot of investment in plant and machinery, which requires a lot of time to recover that amount for any investor. So industry was had this challenge of paying so much import duty at the time of import of capital goods that amount of import duty was also getting blocked along with this capital goods. So someone who is setting up a car manufacturing facility and bringing in machineries from abroad of say $100 million. So his $30 million along with that 100 million are getting blocked in the working capital. So the cost of manufacturing was ultimately increasing for these persons. So they came and they approached the government with the uh, any solution for this, and that's how this duty deferment benefit is being given. So government is saying don't pay duty today to us. You pay duty only when you stop using those capital goods. You can bring in any amount of capital goods. We won't take money from you, and we won't block your working capital in that. So what is happening? Instead of bringing capital goods of 100 million, they can bring in capital goods of 130 million using the duty amount in bringing. So they're expanding their manufacturing core capabilities here in India. So that's how this is kind of nurturing the manufacturing processes and developing the manufacturing strength of India, which is the core objective of this scheme. So we talked about what are the advantages of the scheme. Now we'll move to the other relaxations under the scheme. So there is no standard input output norms which are to be followed under this scheme. So if I'm a manufacturer of some products and I want to bring in raw material under the scheme, so I need not follow the standard input output norms which are notified by the DGFT or any other authority for bringing in raw material. I can self-declare to manufacture so and so product, I need so and so quantity of raw material. And on that basis, I can book my consumption and pay duties. So say I am manufacturer of plastic chairs. So I can declare to manufacture one plastic chair, I need say 100 gram of plastic granules or 120 gram of manufacture. Obviously, this needs to be near to what you need. You cannot exaggerate it, but there is no restriction for you to follow the SIAN norms. This is what I want to highlight. No restriction of sale of output in domestic market. Someone who wants to only import capital goods under the scheme without any export obligation, he can still bring in capital goods and sell his entire 100% production to local market. So that is also allowed. There is no restriction on selling goods in local market, as well as there is no compulsion to export any manufactured goods. Then you can transfer goods from one mover unit or the one bonded manufacturing unit to another bonded manufacturing unit. So if your customer is also registered under the scheme, so you had imported some parts from outside India, you did some processing in your factory, and now you want to shift it to your customer who will also do some manufacturing activity on it. Either he will sell it locally or re-export it. So that duty deferment benefit will pass on from your factory to his factory. So you need not pay duty on such components if the other person is also registered under bonded manufacturing scheme. So ultimately, when after maybe 5 years, 10 years down the line, the duty deferment will flow to the ultimate consumer through this. So if everybody registers their factory under bonded manufacturing scheme, nobody will have to pay duty as long as the goods are removed for consumption. So that's why this benefit is also there. And there is no need to furnish bank guarantee, like I explained earlier. This scheme is all about unblocking the working capital. So the requirement of furnishing bank guarantee, etc., to take the benefit of this scheme has been done away with, and only a solvency certificate from any scheduled bank will suffice and will make you eligible for duty deferment under this scheme. Like any other export promotion scheme, they require bank guarantees like in EPCG, advance authorization, EU, SEZ, some 5%, 10%, 25%. But under this scheme, there is no requirement of bank guarantee. Even if you want to bring in 100 crore worth of capital goods and defer 30 crore worth of duties, import duties, and your company just incorporated with no history and to show your performance, still you can import without furnishing any bank guarantee. So this is the kind of flexibility government has offered under this scheme. So what was the need for bonded manufacturing when there were other schemes like EPCG, advance authorization, SEZ, EU? So all the other schemes had some kind of export obligations attached to it. So through bonded manufacturing, the requirement of export has been done away with. Then the compliances in the other schemes were multifold compared to bonded manufacturing. There were dual monitoring authorities. For advanced authorization and EPCG, there is DGFT involved. For EOUs and SEZ, there is Development Commissioner Office involved. Plus, customs is involved in both. But in bonded manufacturing, only single point of contact or single point of compliance is customs only. There is no other authority involved. So you register with customs, you follow the entire registration process along uh, through customs only, and you import and report to customs only. So that compliance burden is done away with. You have to report to only one authority. No export obligations, simplified compliances due to involvement of only one authority. Then duty deferment for both domestic and export oriented units, which is not there in case of SEZ and EOU. They can avail duty exemption only when the goods are being exported from these units. But in case of mover or bonded manufacturing, you can avail the duty benefit for domestic sale as well as export. So by not restricting mover units to only do domestic sale, this added advantage is there. Even if you want to start exporting products, you can still continue from the same unit. You need not do separate registration under or seek registration under another scheme. Then ease of registration and management, like we already discussed. Then import benefits without time limitations. EOU and SEZs have some 5 years timeline to report and performance. In EPCG also there is timeline of for import like 18 months or 24 months, and you have to complete the export obligations within 6 years. For advanced authorization also there is time limit of 12 months and then export obligation within 18 or 24 months. But under bonded manufacturing scheme there are no such time restrictions. Raw material imported today can stay in your factory for 5 years without any interest or duty liability. As long as it is there in your factory, you need not pay. So why this is important is because in these times of tariff war, you had imported certain raw material for manufacturing and exporting to USA. So that raw material duty free has come to your factory duty free under advance authorization. But since abhi aapka export, you are not able to export because of these tariff restrictions, the timelines under advance authorization will get lapsed. So that complication will arise. But under mover, there is no such timeline. You can export as and when you want, when there is order. So there is no stringent or rigid timelines which needs to be followed under mover. So this is an advantage over the traditional schemes of advance authorization and EPCG. So these all shortcomings of the earlier schemes like dual monitoring, restricted timelines, export compliances, restrictions on domestic sale, all these were done away with this single scheme, bonded manufacturing scheme. Now, who is eligible under this to register under this scheme? So any industry who is doing some sort of manufacturing can register under this scheme. Someone who is doing cutting, polishing, or painting, repainting, even these activities fall under the definition of manufacturing, and even these people can register under this mover scheme, bonded manufacturing scheme. There is no sector-specific restriction. Textiles, automobiles, food processing, dal mill, plastic injection molding, any type of industry can register under this scheme. Further, there is no geographical restriction as well. In any part of India, you can register under this scheme. We have clients in Jammu till Tirupur in Tamil Nadu, and in Assam also, and in Jamnagar also. So everywhere people are taking benefit of this scheme as there is single and uniform implementation is there as the scheme is run through customs department. So any who is eligible, so anyone who is doing some sort of manufacturing activity and wants to import capital goods or raw materials which are required in their manufacturing activity can register under this scheme. So what are the key, what separates someone who is eligible from someone who is not? So they have to have a manufacturing unit with basic facilities, like there should be a boundary wall, there should be fire safety, firefighting equipment, there should be CCTV cameras, security guard. So these basic things should be there. As long as these things are there, they can register under the scheme and take the benefits. And further, there is no minimum investment commitment required. Like in EOU scheme, if you want to register, you have minimum 1 crore worth of, you should have minimum 1 crore worth of fresh investments. Under more, there is no such requirement. Even if you want to bring in, say, 10 lakh worth of capital goods, you can still register under the scheme and take the benefit of duty deferment. Only one industry has been kept out of this scheme. What was happening? People were importing solar panels and associated structures under this scheme to generate electricity, which was then being supplied to the power grids. So even that electricity generation was being shown as manufacturing activity, and that's how they were getting registered under MOA scheme, and they were importing their solar panels and structures duty free. The solar panel, and this was affecting the domestic manufacturing of solar panels, because since there was no duty on it, people were preferring imports from other countries rather than buying it from India. So this was affecting the production of solar panels in India, and thereby affecting the core focus area of the government. So this any capital goods which are required for electricity generation have been specifically removed from the mover scheme benefits. So if you want to import capital goods to manufacture solar panels in India, you are eligible. But you are importing entire solar plant from outside India to set up and only generate electricity, then that is not eligible. So this has come very recently in 24 only. Earlier, whatever people registered under the scheme, they can continue the benefit because this is not a retrospective amendment. This is only a prospective in nature. And government has also introduced a new proviso in budget 24 that they can in future notify the industries which may not be eligible for this scheme. So as of now, only solar industry is there. So like I explained, who is eligible? So any manufacturer importing raw materials and capital goods can avail the benefit of bonded manufacturing scheme. So is it required that it should be a new unit? No. Even an existing manufacturer who wants to expand his manufacturing capabilities by importing additional machines in his factory, even he can register under the scheme. Even someone who wants to import only raw material under the scheme for his existing factory, even he can register under the scheme. So there is no requirement of it has to be a new unit, completely new unit. Even an existing unit can register under the scheme. Someone who is doing only job work, not doing the entire manufacturing process, but only doing coating, painting for someone else, and then sending the goods back. Even that he can register under the scheme and import his capital goods or whatever tools he requires for doing such activity without payment of custom duty and IGST. So even a job worker is eligible, new manufacturers are eligible, even existing manufacturers are eligible. And manufacturers come traders who do some sort of manufacturing and also trade in their raw material, even they can register and take the duty deferment benefit. There is no restriction that even only a company or LLP can register. Even proprietorship firms, partnership firms, anyone can register. There are no restrictions as far as what should be the composition of firm. Now, how the eligibility is determined, how much duty you can save or defer under this scheme. So that duty deferment depends on the amount of solvency the unit can offer. The solvency certificate is not a bank guarantee. It is just a kind of a character certificate which is issued by the bankers to show that so and so company is capable of paying so and so amount in future should the need arise. So government wants to be assured that someone who is taking benefit of mover scheme is capable of paying the import duty amount at a later stage. That's why this requirement of solvency certificate is there. So someone who is furnishing a solvency certificate of 1 crore from his banker, he is eligible to defer duties up to 1 crore rupees. The solvency will reflect the amount of duty and not the amount of machines or capital goods you can bring in. So only duty amount component will match with the solvency. So if you are bringing in solvency of 1 crore, that means your duty eligibility limit for deferment under this scheme is 1 crore rupees. You have to keep on maintaining this 1 crore limit. We have to submit the solvency every year to show that we are still eligible and solvent to that amount. You can increase the amount later on also, but this is a mandatory requirement, and based on this, your limit is decided. So someone who wants to bring in, say, capital goods of 10 crore rupees, so his duty would be around 2.8 CR, including IGST and everything. So if he can furnish solvency of 3 crore rupees from his bankers, he will be allowed to import the capital goods worth of 10 crore rupees. So that is how the solvency is working. Banks normally take 3 to 5 days to issue the solvency. It is generally based on your net worth certificate, whatever is the net worth of the firm. In case of new firms, these firms do face challenge because generally the companies are formed with 1 lakh rupees of share capital or 5 lakh rupees of paid up and subscribed share capital. So the net worth doesn't add up in the books of accounts. But based on the director's profile and the history of the directors and their other firms, banks generally issue this certificate even through such companies as well for whatever amount they need based on their requirements. Because ultimately, if the bank is not giving me solvency, what will happen? I will not register under the scheme and import the capital goods by paying the duties. So as long as I have the money to pay the duty, that's why I'm bringing capital goods from outside India. So as long as we are able to convince this, there is no issue in getting this solvency certificate as well. This certificate is to be issued in the name of Commissioner of Customs. We'll discuss that later on. Now, how it works. So what technically happens, what makes your unit a bonded manufacturing unit? What is happening in the registration process? So basically, we are registering your manufacturing facility as a private custom bonded warehouse. So it will run as if you were running it before, but technically it will be registered as a private custom bonded warehouse with the customs department, who is having jurisdiction over your local area. So by converting the facility into a private custom bonded warehouse, the duty deferment benefit gets activated. So since this is the private custom bonded warehouse, as long as the goods are deposited in the private custom bonded warehouse, that is your factory, you need not pay the duties. So how the import process will differ. So imported goods can be deposited in a private custom bonded warehouse by way of filing of a bill of entry for warehousing. Normally, when we import capital goods or raw materials, we pay the import duties by filing bill of entry for home consumption. So by filing bill of entry for home consumption, we are saying that we will remove these goods and take it to our factory and we'll pay the duty. After that, whatever we do, government has no business with that. But by doing the warehousing, we are saying we are not removing these goods or making these goods part of normal goods in India. We are just storing the goods in a private custom bonded warehouse and will report to its usage and its consumption as and when this happens. So by converting the manufacturing facility into a private bonded warehouse, you can import the goods with the benefit of duty deferment. The process is different of import. Like at the time of normal import, we file the bill of entry for home consumption. While bringing goods in a mover unit or a bonded manufacturing unit, we file the bill of entry for warehousing. This once deposited, once the goods are deposited in your factory, which is now a private custom bonded warehouse, you can carry out any activities. You can consume the goods or use the goods as you want, like you have been using in your normal factory. There is no restriction that this should be kept in particular area of the factory. Only the activities that were mentioned at the time of application can be carried out. Only those products can be manufactured. You can expand and extend and treat it as a normal capital goods and use it for your manufacturing activities. There is no requirement of you to furnishing photos and videos of these goods periodically to the customs. No such requirement is there. It's just whatever you were doing earlier, you need to operate the same way. Just by why I'm elaborating this point is people get confused when we say ki, since the factory is a private custom bonded warehouse, it comes under the physical supervision of control, physical supervision and control of the customs. But it is not the case. Only technically we are registering the facility as a private custom bonded warehouse. You will continue to run and operate your manufacturing unit as it were a normal manufacturing unit. There is no separate restriction or compliance that you need to do apart from the monthly reporting at the end of the month, how much capital, how much duty-free goods you have brought in, and what is the status of those duty-free goods, how they moved from your factory in your factory in the last month. So as we discussed, when the manufactured goods are cleared for local sales using the duty-free raw material, we'll have to pay the proportionate import duty consumed in manufacturing those finished goods. If the goods are exported, there is no requirement of paying the duties. Many people get confused. What if we bring only capital goods under the scheme? So whether the duty which we defer on the capital goods, will that get subsumed in the finished products or output that I'm generating from that capital goods? And will it be apportioned or proportioned to all the whatever is the manufacturing capacity of that machine? Say I'm bringing in some machine for manufacturing 1 lakh units of some product. So whether that import duty will be divided between this 1 lakh units of product and I will have to again pay this duty when I'm selling this 1 lakh products. So no, that is not the case. I will pay duty in case of capital goods or machines only when those machines will physically move out of my factory. whatever is happening to the products which are generated, which are manufactured using those machines, is of no concern as long as the duty deferment of machine is concerned. Yes, but if I am using imported raw material to manufacture those products, then obviously the duty I will have to pay when I am selling that final product. Or if I am exporting the final product, then duty is not required to be paid. But as long as the machines are there, the duty is to be payable only when I am physically removing or selling the machine and removing it from my factory. What will happen if I export the machine as it is after say 5 years I am using the machine? After 5 years, I don't want to sell it locally or physically remove from my factory, but re-export it to some other country. So in that case, you won't have to pay the duty. This is what the circular and notification say. But it also refers to the customs valuation rules as to what value this machine should be exported. That we need to determine at the time of export. And say if you imported the goods at 100 rupees and now you are reselling or re-exporting at 50 rupees valuation. So that balance 50 rupees of difference, that 50 rupees proportionate duty we will have to pay in India. And whatever value you are realizing for the export, that much proportional, you need not pay the duty. So there is a blanket kind of understanding in the market that if we re-export the capital goods, we need not pay duty. But it's not like that. If you are using some goods for 10 years in India, and then re-exporting, say you had imported something at 100 rupees and then exporting at 10 rupees as a scrap after 10 years, that doesn't absolve you from the import duties for the difference amount of 90 rupees. So what is the process of procurement of raw material and capital goods? So through this chart, we can see that we can bring in domestically procured raw material and capital goods by paying whatever applicable GST and IGST. Just simply by converting our factory into a bonded manufacturing unit, there is no direct benefit of GST. Since this is a scheme which is introduced by customs and is administered by customs, only duties which are charged and collected by customs are covered as benefit under this scheme. Since GST, CGST is not charged and collected or not levied under Customs Act, these duties do not get automatically deferred because they are being procured by mover unit. In case of imported raw material and capital goods, you get the deferment or exemption of BCD and IGST. Depending on exemption is why we are saying exemption, because if you re-export the finished goods, that deferment gets converted into exemption. Clearance of manufactured goods. First, we saw how to procure the goods and what is the tax implication. Now we are seeing how to clear the manufactured goods. So if the goods are directly exported from the manufacturing facility, then the BCD and IGST on the raw material will get automatically exempted. And if we are selling the finished product locally, then whatever is the proportionate BCD and IGST, we need to pay. Now, how to pay this BCD and IGST? Do I have to charge to my customer on my sale invoice and collect it from them? So no, this is not, your customer won't even know that these goods are coming from a bonded manufacturing unit. You will have to charge him whatever you were charging him before. It will be a normal sales invoice for you, but you will have to pay this duty on back end. So how to pay these duties on back end? When we import the goods, we will file the bill of entry for warehousing. Say we had imported 1,000 quantity of some certain raw material, and the bill of entry for warehousing is filed. So that 1,000 quantity will show as those goods are lying in my factory. So if out of that 1,000, say I am consuming 100 quantity for local consumption, domestic sale. So only that 100 quantity duty, proportionate duty I will pay. How I will pay? I will file a new bill of entry, which will be linked to this bill of entry for warehousing, only for 100 quantity. This new bill of entry will be filed for home consumption now, also known as ex-bond bill of entry. So this is the technical term. This is a normal process for someone who is doing import and export. I'm just explaining how the duties are to be paid. So essentially what we need to understand is we don't have to collect and charge the import duties from our customer. These duties need to be paid at the back end by us through the IceGate portal, just like we are paying duties in case of reverse charge mechanism. In case of clearance of capital goods, so here we saw domestic clearance of manufactured goods. Now what about the capital goods? So if we are exporting the capital goods from the facility after their usage, there is exemption from BCD and IGST only for that portion which you are getting realized through that export. Whatever you are not realized and is the difference between your import value and ultimate clearance value, that much duty will still have to pay without any interest, obviously. And if we are selling the capital goods as a scrap or even as a second-hand goods in locally, then entire duty that we initially saved, we will have to pay the without any interest, obviously, and then we can sell the capital goods locally also. The register after once we register the factory as a manufacturing or bonded manufacturing unit, it allows us to import goods multiple times. It's not like only first or second shipment of capital goods is duty free, and then after again we have to do this registration process. The registration is a lifelong registration. It is a continuous registration as long as we are maintaining the condition of solvency and the security structure of the factory, just like the boundary wall and etc. So there is no need to renew this license in every 3 years or 5 years. This is kind of a one-time registration of the factory without any requirement of renewal. So even if you want to import capital goods after 3 years, 5 years, 10 years, again, you are not required to apply for fresh registration. This single registration will allow you to import capital goods at later stage also. And the same treatment we will have to follow as and when we sell the capital goods. So what is the registration process under the scheme? So like I said, any new unit or an existing unit can register. So registration process is, there are government has partnered with Invest India portal. Just like Make in India, there is a department of Invest India. They run a website, investindia.com. So CBIC has partnered with Invest India. So we need to start by registering first our application on the Invest India portal, and by submitting the physical file with the jurisdictional custom authority. So if I have a factory, say in Gujarat, and I am importing from Nhava Sheva port, which is in Maharashtra. So do I have to register at Nhava Sheva port or the customs authorities at Gujarat? So the answer is I will have to register with customs authorities at Gujarat. So there are 3-4 commissionerates in Gujarat. One sits in Jamnagar, one in Ahmedabad, one in Kandla. So depending on in whose jurisdiction my factory is falling, I will have to register with that particular commissionerate by first applying on the Invest India portal and then filing the physical submission with the jurisdictional authorities. Then they take around 10 to 15 days to verify the documents application. If everything is satisfactory as far as the documents are concerned, a customs superintendent is appointed to visit your factory to physically check whether the security parameters that we are mentioning, boundary walls, CCTV, firefighting equipment, etc. are there. So the purpose of this physical inspection is to ensure that the goods that we are bringing in this scheme are safe. The premises is safe enough, secured enough to store these duty-free goods. Because even though the goods belong to us, but the amount of duty, that is the investment of the government in those goods. So tomorrow, if someone is not able to pay the duty, at least government can confiscate the goods and recover the duties. So to ensure that the goods are secured in that particular facility, this inspection is done before giving the license. We saw, the purpose of the inspection is to ensure the safety and security of duty-free goods. Based on his inspection and supervision, the superintendent of custom will prepare and file a report with the jurisdictional commissionerate saying I had personally visited the facility and these are my observations. And then based on his verification report, the commissionerate will issue the license subject to all the formalities related to further documents if there are any deficiency in everything. And that license, once is issued, is valid for lifelong for that particular unit. So if a company is having multiple manufacturing facilities, even in the same city, will have to apply separately for each facility. Just by registering one unit, the registration is not automatically extended to all other manufacturing units, because mover registration or bonded manufacturing registration is a premises specific registration and not a company or assessor specific, because it involves physical infrastructure factory. Like in old excise, the registration was factory specific. Every factory had its own excise registration. In mover scheme also, the registration issued will be valid only for that particular factory. Once the license is issued by the commissioner, then a warehouse code is appointed or allocated to that particular factory. So this warehouse code is allocated to that particular address which is being registered as a mover unit and not to the entity which is being registered. So we can use this warehouse code while at the time of import for filing that bill of entry for warehousing. So to file a bill of entry for warehousing, warehouse code is mandatory. and warehouse code can be issued only after this entire registration process is followed, and only for that particular only for those goods import shipments which will go to that particular factory which is registered as a warehouse. Now, what are registration timelines? The registration process involves multiple steps, like we have to submit a physical application, then there is initial scrutiny, issuance of physical letter, physical verification, approval, and generation of warehouse code. Recently, the board has started to move this entire registration process online on the IceGate portal itself. So till now, Invest India was the portal on which applications were to be done. But since last, say, 1 or 2 months, they are shifting now to warehouse module on the IceGate portal. So the applications in future will go to through IceGate only. So typically it takes around 6 to 8 weeks to get this entire process done. I have given the bifurcation to prepare the documents 1 week based on our experiences. Generally, it takes 1 to 2 weeks to get the physical letter for physical inspection. Another 1 to 2 weeks to get the physical inspection done and submit the report to the commissionerate. And based on the availability of officers at commissionerate, the file is approved within 1 to 2 weeks. So if you want to bring in capital goods, we need to plan in such a way that we have at least time of 2 months before the goods arrive in India at the port of import. Because to file the bill of entry, we need the warehouse code, and warehouse code can be generated only after we do this entire registration process of 6 to 8 weeks. This is the normal timelines depending on the availability of documents, the eligibility through solvency certificate, and the construction status of the factory. Typically, we have seen most of the units which register under the scheme are registering to import their capital goods and plant and machinery. And these new units, since they are under construction and the capital goods arrive before the entire setup is ready, because they create the foundation and the basic structure, shared structure, and then the capital goods are installed, and then the structure around it then is closed because they need some space for movement of capital goods, installation of cranes, so all these things. So typically the factory is not ready before the capital goods arrive in some cases. So there is a circular number 34, which specify that in case of some manufacturing processes, it may not be required that the entire premises is closed from all sides, as long as there is controls, sufficient controls to control the access to the premises, and the security and CCTV, everything is there. Even such units can also register under the scheme. And this, again, coming back to the timelines, the construction status or the construction status of the factory, we need to plan in such a way that the capital goods arrive arrive at the port only when the sufficient construction or the basic construction related to physical security, like boundary wall, security guard cabins, structure of the shed, foundation of the machines, etc. is ready. Then only we should plan the shipment of the capital goods. Because practically what happens, people order their capital goods based on the availability of their finances. And when the capital goods arrives in India, they are not able to file the bill of entry under mover because their factory is not ready. Because factory is not ready, we cannot get the physical inspection done and submit the report to the commissionerate, based on which he will issue the license. So this delays the process, but the goods arrive at the port of import. So in this case also, practically you can shift the import shipment to a public bonded warehouse. And from the public bonded warehouse, whenever your factory is registered and your more license is ready, we can shift the goods from the public bonded warehouse to our factory and report the compliances. But this will obviously increase the cost, transportation cost, handling cost and also the cost of storage at the public bonded warehouse for the assessee. So the registration and the import shipment should be planned in such a way that we get the goods in India only after our license is issued and warehouse code is generated against our factory address. So what are the key documents in registration process? So solvency certificate is one of the key documents which determines your overall and total eligibility under the scheme. So the solvency certificates needs to be addressed to the Commissioner of Customs, who is having jurisdiction in your factory. It should also include the amount of solvency. It should also include your factory address for which you are registering, because one company may have multiple units and they want to register all the units under mover scheme. So they need to furnish separate solvency certificate having each factory address as a location in those certificates. Then we also need to submit an insurance policy in the name of President of India through Commissioner of Customs. The purpose of submission of this policy is to ensure that if the goods get lost in the factory for whatever reason, the duty amount should directly flow to the Commissioner of Customs. So there is a custom duty package policy, concept of custom duty package policy issued by most of the insurance. So whatever is the duty amount we are trying to defer under the scheme, for that same amount we need to furnish the insurance in the name of Commissioner of Customs. Then there is a requirement of site plan, which should clearly show entry, exit, what is the production area, storage area. All this should be marked in the site plan so that they understand where you will be keeping the capital goods, where your raw material storage area is, how the goods are moving in and out of the factory. Then we also need to appoint one person as a warehouse keeper. Since there is no physical supervision and control of the customs authorities, a warehouse keeper is nominated to act as an eyes and ears of the customs. Though he is the employee of the assessee who is registering under the scheme, but he is essentially doing the role of customs authorities by keeping the records of goods, which duty-free goods which are arriving in his factory, how the goods are issued for production, if those goods are sold, paying the duties. So everything is done through this digital signature or the approval of the warehouse keeper only. So we need to appoint someone with sufficient experience in customs regulations or customs procedures and policies who can act as a warehouse keeper. It can be a director of the company or partner of the partnership firm, but the proprietor or the owner itself cannot be appointed as a warehouse keeper. So there is a requirement of fire safety audit report just to show that the premises is compliant with the fire safety regulations as are applicable to his jurisdiction or area. So these are the key documents. Other than that, your normal company related KYC documents and what the details of the goods, pro forma invoices of the goods that you want to bring in, all these things are also required. But these are the key documents which kind of determine how much time your registration process is going to take. Now, how the import process is different under a mover scheme as compared to a normal import process. Like we discussed earlier, instead of filing a bill of entry for home consumption, the mover units file a bill of entry for warehousing. So I will first explain the normal import process. In normal import cases, an IGM is filed by the captain of the ship who is bringing your goods into India. Once the IGM is generated within 24 hours, we have to file the bill of entry saying ki so and so goods belong to us. We have the invoice and everything, and we want to pay the duty and clear the goods. Based on our bill of entry, the goods are assessed, the documents are verified like invoice, copy of bill of lading and everything. And an assessment order is passed and duty liability is finalized. Once we pay the duty, submit the challan, the goods are removed and we can take the goods to our factory. This is the process for normal import. But in case of import by a bonded manufacturing unit, we file a bill of entry for warehousing. By filing a bill of entry for warehousing, we are declaring that these goods will be used for manufacturing activity at certain particular location. So we have to provide additional documents to prove that the goods will be taken to that particular location only. There is ample storage space to store these goods at the particular location. We also have to submit proof that the goods have actually been taken to that location only. So all these documents that we will be discussing now, they comply with these conditions, which are added, what we can say, confirmations required at the customs port to ensure that the goods are actually moving to the location for which registration is granted, like a space certificate. So which we need to provide to assure customs that there is sufficient space at the mover unit to store these imported goods. So who can issue a space certificate? Again, the warehouse keeper is nominated. He can only justify and say there is space for these goods at my location. Then a transit bond is required. A transit bond is nothing but a triple duty bond which is taken by customs to ensure that the goods are safe during this journey from the port of import till your factory. So should there be any accident or any misfortune with the vehicle, then the duty amount is required to be paid by the SSC to the customs, because the purpose for which goods were released by the customs port, that did not get accomplished. The good did not reach the warehouse. That was the ultimate destination. Therefore, if the goods get lost in the journey, it is required to pay the entire duty on the goods. So how will they recover the duty? Through this transit bond. So in this transit bond, we give a undertaking to the customs that we will take the goods to our factory only, and should there be any loss to the goods, or if there is any shortage in the quantity received at the factory, we will pay the duty. Then again, once the goods are received at the factory, we have to account for those goods and reconfirm to the port of customs that the goods have actually received in my factory, in a simple one letter format, saying so and so goods left through so and so bill of entry have arrived at our factory through so and so vehicle. This was the log number and etc. And this is just kind of a confirmation for the port authorities that the goods actually received. Again, the space certificate and re-warehousing certificate, both are signed by the warehouse keeper only. There is a requirement to submit this re-warehousing certificate within 30 days from the once the goods are received at the factory, but there is no strict vigilance around it. But it is as per the law, within 30 days we have to submit this. Based on the submission of re-warehousing certificate, the transit bond that we are submitting for this journey get cancelled. So this is not a so the purpose of the transit bond is only to cover the journey. As the journey gets culminated in my factory or terminated in my factory, and I submit the re-warehousing certificate showing the goods have arrived at my factory, then the bond gets cancelled. So when to pay import duties and how? Now that we have got the goods duty free in our factory, how do we pay the duties if we are required to pay the duties? So the so when are duties paid? So in case of imported raw material, if I am consuming the raw material in manufacture of finished products which are again sold domestically, then only I am supposed to pay the proportionate import duty. How to pay the duty? By filing a new bill of entry for home consumption, which will be linked to my original bill of entry. This is a process which is done by the CHA of the company. We are just discussing it because it's too technical to explain in such short period of time. But it's a very basic and normal process. So by filing a new bill of entry, we pay the proportionate duties. Then again the duties are to be paid at the ICE gate only. The requirement is to pay the duties online only. So we can file multiple bill of entries again, a single bill of entry for warehousing. Say somebody has got 5 machines duty free under mover scheme, but all the bill of in a single bill of entry they had imported 5 machines. But out of those 5 machines, only one machine they now want to sell or remove from their factory, for maybe reselling it to some other company. So they need to file a new bill of entry for only one single quantity of the machine. Based on that, proportionate duty for one machine only will be generated through that bill of entry. They can pay that duty, and then only they can physically remove the machine and sell it to the party. Now, my original bill of entry will have only 4 machines left, which I will have to pay the duty as and when they go out of this factory, go out of my factory. So what are the compliances under the scheme? A bond register is required to be maintained as per the format prescribed by the customs authority. The purpose of the bond register is to track the goods of movement of the goods, how much imports we have done, whether the goods are issued for production in the factory, or whether the goods are physically removed from the factory as a trading, or whether they are removed in the form of finished goods. So everything is registered, or everything is recorded in this bond register, serially, date wise, and supported by the invoices or the bill of entries or the shipping bills as and when. So it's just kind of a register which we need to maintain in Excel. Excel or any software you have, you can maintain that as well. But essentially, the purpose of maintaining is to capture the entire movement of the duty-free goods, right from the day they arrive in my factory till the day they are cleared from my factory and duties are paid on them. Or if they are exported, we have to report accordingly. So that by looking at the bond register, anyone will be able to understand how much duty you are saving at one particular date of time. So by looking at the debit side of the bond register and credit side of the bond register, you can calculate your duty savings at one particular point of time, and based on that decide your future course of actions. At the operational level, records must be maintained for each duty-free input and raw material. So this is just like the bin system, and mostly the factories have their own system of recording inventories. Now, the main part of the compliance is that how will the customs know how much we have in our factory, how much is issued for production, and how much is sold locally. So every month, within 10 days from the close of the month, the warehouse keeper is required to file a monthly statement of stock, which is also known as monthly return, to his jurisdictional custom officer. How the return is to be filed, he can email it to the officers, or he can submit a physical copy also. This return format captures the entire movement of the goods, in through which bill of entry and vehicle the goods arrived in your factory. Out of those goods arrived, how much goods were issued for production, how much were sent for job work. All these details are captured in the return format. All spaces and columns are provided, and how much quantity is lying in stock. All that is there. So this report is submitted by the warehouse keeper on a monthly basis to his jurisdictional custom officer. So someone who is bringing only capital goods and he is not importing any raw material under this scheme, so he will have to report his import only in the month in which his capital goods arrived. For subsequent month onwards, since he is not importing any duty-free goods, or there is no further movement of those capital goods out of his factory, those returns will go as a nil return. Though there is a requirement to furnish the data related to your local procurement as well, the return does have the format or the columns to capture the domestic procurement as well. But practically nobody is feeling this because there is no duty implication involved, and the authorities also don't want that many details to be captured. But practically, legally you are required to fill all the columns. But practically, someone who is bringing in capital goods is filing nil returns for subsequent periods. Only when there is movement of the capital goods, that is being reported through the monthly returns in those particular months. On an annual basis, this was the monthly compliance return. On an annual basis, the unit must also submit solvency certificate, renewed solvency certificate, renewed insurance policy, and updated fire safety audit report to maintain its eligibility under the mover scheme. So, whenever there is completion of 1 year from the date of license, you will have to submit a renewed solvency certificate. Since insurance is again valid for 1 year, we have to renew that. And again, fire safety audit report also periodically we have to submit. So these things are must to be submitted. Doesn't mean we have to submit this thing and again ask them to issue us a new license for next year. No, we just have to intimate them that we have these things on record and we are now furnishing it for your records. That's it. This is kind of an intimation that we have to submit every year and doesn't require any approval or consent of the authorities to take this thing forward. Now, any significant changes to the unit's operations or details that were submitted during the application process, like there is addition of products which we reported at the time of registration. Now there are certain additional products. So these things we need to keep on reporting as and when these happen. There is some structural change in the factory, like some empty space. Earlier there was some empty space. Now we are constructing some storage space there or some shade. So these kind of changes we have to intimate to the authorities. They may require some visit from the officer if you're changing like structure of the factory or anything. But most of the cases, these things work only as an intimation, which we need to keep them informed about our changes in activity. Now, exit from mover scheme. So we have seen what is the registration process, what is the exact benefit, how to pay the duties, what are the compliances. Now, exit from mover scheme. So who should exit from mover scheme, or why should one exit from mover scheme? There could be multiple reasons for which people want to exit from mover scheme. Someone who registered for, say, importing only raw material under the scheme. Now they found a local source who is supplying raw material domestically from India. So they are not having this requirement of import of raw material. So they might want to exit from the mover scheme. So to surrender and to stop the compliances. So whenever we want to file an application for exiting from the scheme, we need to submit a record of entire history of how many goods we brought in the unit, their treatments, if they are still in my factory or if they are exported or duty paid, entire record relating to input and output we have to submit. Whatever duties are there lying in the stock with me as on the date of surrender, we need to pay the proportionate duties on those goods and submit the challan along with all the monthly returns and everything to the jurisdictional authorities. Based on our application, again, one physical inspection is done to check whether actually such goods are lying in the factory or not. And that final inspection report is submitted by the officer to the commissioner saying ki, now the duty with respect to all the goods that were imported duty free under the scheme has been discharged by the party and there are no further compliances pending and we can cancel the license. Because the mover license is, since there is no periodicity attached to this license. This license is valid sine die as long as it is not cancelled or revoked or suspended. The license is valid. So we have to take those steps, active steps to cancel the registration. Now, what are the other aspects relating to this mover scheme? So recently in budget 2023, government had introduced section 65A to exclude IGST and compensation from the duties that are deferred under the mover scheme. Further, this section also proposes that the class of goods will be notified at a later stage. But as of now, in 2025, till 2025, this section is still not notified and nor the classes of goods for which this section will apply. So essentially what the government is saying, we will take away the benefit of IGST deferment through this section. But as of now, today, this section is not yet notified, it is not in force, and you are still eligible to defer the entire import duties, including BCD, sales, IGST, anti-dumping duty under mover scheme. It is our understanding that whenever this section is notified, it will only apply to raw material or imported raw materials and not to the capital goods, because if the section is applied to the capital goods, the scheme may not remain viable for most of the units, because the portion of custom duty is hardly 8.5%, 8.25%. So this is the understanding, but till now the section is not yet notified and you can still defer the IGST around it. Now, what is the treatment of depreciation under income tax? So capital goods imported under mover scheme are also eligible for depreciation under income tax. There is no restriction in the Customs Act. There is no restriction in the Income Tax Act on claiming depreciation on the capital goods imported under mover scheme. So to discuss this thing, depreciation is not allowed while computing your duty liability at the time of final sale of the capital goods. So if you are imported capital goods, say at 100 rupees, you saved 30 rupees of import duty, you are still required to pay this 30 rupees of import duty, even if the capital goods are written off in your books after say 5 years or 10 years. You don't get depreciation while paying the amount of import duty. This has nothing to do with the income tax depreciation, which you were otherwise also eligible to claim on this value of the machines. So this is just a clarification point. There is no restriction under income tax. If you are bringing in capital goods under mover scheme, you can still claim the depreciation under income tax. There is no specific restriction. The depreciation is not available on the amount of custom duty because you are not ultimately paying this duty as on the date. So this is the overview of the mover scheme. Practically, we are seeing that MSMEs across India are registering under this scheme to take the advantage of duty deferment, because anyone who is importing say 2, 3, 5 crore worth of capital goods is also incurring heavy amount or amount of import duties. But by simply registering their factories under mover scheme, they can defer this entire import duty component of 30% and use that money to import say certain additional machines or capital goods, or they can use that machine for the working capital requirements of their business, because there is no interest involved. They're having this kind of interest-free loan from the government as far as their capital goods are covered. So sectors such as Ludhiana, Tirupur, then Ichalkaranji in Maharashtra. These are having multiple factories registered under this scheme because they require continuously the new machines every 3 years or 5 years. So by registering under this scheme, they are deferring their import liabilities on each import of shipments, and by saving that import duty and increasing their working capitals. So these are the people, these are the sectors which are actively using this mover scheme, be it textile sector, be it your metal processing cutting sector from Hosur in near Bangalore, and textile sector in Tirupur, Ludhiana, Ichalkaranji. Then there are laser cutting and these sectors around Pune. Then in Delhi, in Manesar, all these applicants or MSME units are taking benefit of mover scheme and registering under this to defer their import duties. Now, one more point is there, even anti-dumping duties can also be deferred under the scheme. So recently in 2023, December or October 2023, government had come up with anti-dumping duty on laser cutting machines. So, whosoever wants to import laser cutting machine, he is also registering under MOA scheme just to defer the anti-dumping duties, because no other scheme allows the deferment or exemption from anti-dumping duties. Even under EPCG scheme, we have to pay the anti-dumping duties, even though we are undergoing the doing the export obligation, but still anti-dumping duty is payable. But only mover scheme allows you deferment for the anti-dumping duties. And even recently in June 25, government had come up with anti-dumping duties on injection molding machines. So this industry is also now turning to mover scheme to import their capital goods under this scheme. So what are the other issues? Can we transfer the capital goods from mover scheme to EPCG scheme? So today, if someone is registering under mover scheme to import his capital goods, today they don't have any export obligation or export orders in hand. That's why they are not sure of going for EPCG scheme. EPCG schemes allows you 100% exemption from the import duty if you complete certain export obligation, whereas there is no such export obligation under mover scheme. So today, when I am importing the capital goods, since I don't have any export orders, this is a new manufacturing unit. I am registering under mover unit and importing the capital goods with the condition that whenever I sell these capital goods, I will pay the entire import duty back to the government. Say after 3 years down the line, I start to get the export orders. And now I'm confident that if I can transfer my capital goods from mover scheme to EPCG scheme, I can fulfill the export obligation and convert my deferment into exemption. So whether this is allowed. So there is no clear guidelines or simple yes or no for this, but the more regulations or more FAQs do mention that something which is allowed in other schemes otherwise is also allowed to you as a mover unit. So to transfer your capital goods from mover scheme to EPCG scheme, in my view, it is allowed because EPCG scheme does not allow the import of second-hand goods. In import, what is happening is I am only transferring goods from my mover unit to an EPCG license. The goods are not changing hand, though they may qualify as a used goods because I am transferring the goods to EPCG scheme after say 2 years of use or 3 years of use. But the goods are not changing hands. This is the same entity which imported them, and this is the same entity which is also applying for EPCG. And since technically the EPCG scheme mentions that second-hand goods are not allowed to be imported in EPCG scheme, therefore, transfer of capital goods which were earlier imported under mover scheme is possible under EPCG scheme. The second argument in favor of this transfer is that earlier EOU units, which were technically registered under Section 58 and Section 65 of Customs Act, they were also allowed to exit from EOU scheme under EPCG scheme. If at the time of exit, they can transfer their capital goods under EPCG scheme, complete their export obligation, and enjoy the benefit of exemption. So mover is nothing but an export-oriented registered as a Section 58 and Section 65 unit, which was the technical registration of EO units before say 17 or 18. So even that works in the favor of this argument that it is possible to transfer goods from mover scheme to EPCG scheme should you have this confirm orders for fulfillment of export obligation. But if you had imported second-hand capital goods initially under mover scheme, because mover scheme allows you to import new as well as second-hand capital goods. There is no restriction as to the nature of capital goods. But initially, if you had imported second-hand capital goods, now obviously you cannot shift those second-hand capital goods to EPCG scheme at a later stage. But if the capital goods imported earlier were a new capital goods which were never used, and then such capital goods can be transferred to EPCG scheme, transferred to the EPCG scheme. Then there is a issue of rod tape and duty drawback. So since exports made by mover unit are not eligible under rod tape incentive, whether the goods are partly processed or fully processed in a mover unit, they just because they were processed in a mover unit, they are not eligible for rod tape incentive. So someone who is importing raw material under mover scheme and then exporting the finished products, he will still not be eligible for rod tape incentive because of this specific exclusion of mover scheme from the rod tape guidelines. This incentive is available to them if they are importing their raw material under advance authorization scheme and then exporting the final product. But under mover scheme, they are not eligible. We are not sure why this restriction is there, but it is still there, and this is kind of making mover scheme unattractive to those who want to actually start exporting the goods. Maybe at a later date, mover units will also be eligible, but as of now, they are not. So technically, we have covered entire ambit of question, the introduction of mover scheme, how it is working, what are the registration process, compliances, who is eligible, how he is eligible, how to pay the duties, what is the registration process and documents required, and whether other incentives are available or not. Now, I think Rakesh sir.
Yeah. Hi, sir.
Yes, sir. So we have covered the PPT, sir. Should we
Okay.
open it for the discussion?
Ravi
Yes,
sir,
Do you
do
have
we
any
have any
questions?
question?
yes, sir. Yes, sir. We have a few queries. Just let me send you.
So there is one question
Yes, sir.
regarding this. What if the party is transferring of the capital goods to one manufacturing unit to another manufacturing unit?
Hmm.
If the scrap as per SION fixed under, I don't know, this is the later question, but this is the question I'm getting. If the scrap as per SON fixed under advanced license is 35%,
Hmm.
will there be any duty applicable on the scrap generated under this scheme? If the
Okay,
unit
sir.
moves to mower scheme, what happens to the stock related to the advanced license at the time of moving to mower?
Okay. So first question you had was that
Yeah.
whether
What
it is
if the
possible
party?
what
Yeah.
if the party wants to transfer capital goods from one factory to another factory?
Yeah.
So in this case, they will have to register both the factories under the mover scheme. So the new factory also they will have to apply under mover scheme, complete the registration formalities for that factory, and then only you can transfer the capital goods from this factory to that factory. Since there are, if they're assuming that entire capital goods are transferred from factory 1 to factory 2, then you can surrender the more registration for factory 1 and continue to do the compliances for factory 2. But if only you want to transfer some capital goods to the another factory, then both factories will continue to register as more units, and you will have to comply, make good the compliances for the both the units. But
Okay.
transfer is possible, but only after the registration is granted, that transfer is feasible.
Okay. And the second question is, if the scrap as per SON fixed under advanced license is 35%, will there be any duty applicable on this scrap?
So, assuming since the scrap is under advanced license, means you want to understand whether the scrap generated for manufacturing FG finished product, which is ultimately exported, what is the treatment of that scrap? So there are two types of scraps generated. One is for manufacturing products which are sold locally, and one is for the products which are sold exported. So there is a different treatment for both these scraps. For the scrap which is sold generated during the manufacturing of domestic products, I will have to pay entire duty proportionately on the scrap value also. So it doesn't matter whether the scrap is 5% or 35% or 10%. Because if I am issuing 100 goods for manufacturing for local sales, then I am supposed to pay the duty on the 100 quantity. Whether out of that 100, only 90 are getting converted into FG and 10 are getting scrap is not relevant. Because for domestic, it is just a deferment. If had I not registered under mover scheme, I would have paid duty for 100 at the port of import. Then only the goods would have been released to my factory, and then would have this consumption been done. So for domestic sale of goods, the scrap generated has no relevance as far as duty implication is concerned. Whatever goods are issued for production, the duty is payable on the entire uh, lot. However, in case of export manufacturing, we need to pay duty on the scrap only as if the scrap has been imported into India. So if say the scrap as per SIAM is 35%, and you had mentioned that 35% only at the time of filing your application for more registration, because at the time of registration, we have to mention everything in our application, what products we are manufacturing, what is the scrap and everything. So that's this 35% scrap. We have to treat this scrap as we have imported this scrap into India. Whatever is the net realizable value of that scrap. Say if I am selling the entire scrap for 10,000 rupees to a vendor, scrap vendor, then I have to pay duty on that 10,000 rupees as if I had imported that scrap into India. So if the BCD for scrap is say 7.5%, so I will have to pay say 7.5% and the cess and IGST on that 10,000 rupees value only, not the proportionate value of those inputs. This is for export manufacturing.
Okay. So the next question is, how does this from other duty exemption schemes like SEZ, EOU, or EPCG?
So, like we discussed in this during the course of this presentation also, EPCG scheme has export obligation attached to it. So if you are saving say 30 rupees of duty under EPCG, you have to export 6 times of that duty saved amount. Whereas under mover, there is no export obligation. If you are saving 30 rupees today at the time of import, you have to pay these 30 rupees back to the government when you scrap the machine. Though there is no export obligation, but there is this conditional liability upon you to pay back the duty. So this is the difference between EPCG and mover. Mover is a deferment scheme, whereas EPCG scheme is an upfront exemption scheme subject to fulfillment of export obligation. So if you don't fulfill the export obligation, you will have to pay the duty along with interest. The interest will be charged from the day you had imported the goods. So after 6 years, I am not able to complete the export obligation. So I will have to pay interest for 6 years along with duty to close that EPCG license. But under mover scheme, if I am selling the goods after 6 years, I only have to pay the duty without any interest for this period of 6 years. So this is the difference. So only when you are sure of having export orders in your hand, then only you should go for EPCG scheme. Otherwise, you should import the goods in mover scheme only because there is no export obligation attached to the goods.
Okay. And so, what type of businesses can apply on this scheme, the bonded manufacturing
One
scheme?
minute, sir. I will again like to go back to the earlier question because he had mentioned 2, 3 schemes, EPCG,
Yeah.
EOU, and SEZ also. In
Okay.
EOU scheme also, the registration is granted by the development commissioner based on the export guarantees that the unit furnishes. We want to import predominantly so and so raw material and under EOU scheme. We will manufacture the goods and export it out of India. So you are taking an export obligation, then only you are getting the benefit of export-oriented manufacturing in India. But under mover scheme, there is no such guarantee you have to furnish. If you get export orders, you will convert your deferment into exemption. If you don't get export order, you will sell the material locally and pay the duties. But under EOU, you have to compulsorily fulfill your export obligation. Say at the time of getting the EOU registration, you had committed that 80% production will be exported. So after 5 years, when you go for renewal, you have to submit the documents to prove that whatever commitments you have given at the time of registration, you had fulfilled those. Otherwise, there will be implications for you. Maybe they might levy some additional condition while renewing your application for the next 5 years. And plus, there are restrictions on domestic sale as well. You cannot sell more than 50% of your export turnover in the local market. So in an EOU, you can never outsell or cross your export numbers and sell the your majority turnover in the domestic market. But in more, there is no such restriction. You can sell 80% in local as well as 20% in export, or vice versa. Also 80% in export and 20% in domestic, without going into the hassle of reporting and then confirming these things. Essentially, earlier before 2011, EU units were eligible for income tax exemption, which was 2011 was the last year for that exemption. So after that, there is no additional benefit under EU to you. Even SEZ units had the sunset clause, say in 2021, whatever units which were registered under more SEZ scheme after 21, they are also not eligible for income tax benefit. But under more scheme, this flexibility is given to you. Key based on your status of business, you can decide whether you want to export or sell locally, and there is no obligation attached to it. While SEZ you can set up in a nominated area only. EOU and bonded manufacturing units you can set up anywhere, or even convert your existing factory into these schemes also. That is also allowed. Yes, sir. We can move to next one.
Next one is what type of businesses can apply for bonded manufacturing scheme?
So anyone from a proprietor, partnership firm, even HUF, anyone who is allowed to have a PAN, he can start a business under bonded manufacturing scheme. There is no restriction. The unit should have PAN. He should have a GST certificate registration for the factory. The factory should be, like we explained, there should be a boundary wall, security guards, CCTV, fire safety equipment, etc. So composition of unit doesn't matter. It can be a MSME, it cannot be a MSME, large unit, small unit. As long as these basic things related to factory are taken care, anybody can apply for this scheme. Even a new unit or even a existing unit can be converted into a bonded manufacturing unit.
And the service provider can benefit from this scheme?
No, sir. The scheme is launched
Only from
promoting manufacturing. Though someone who is doing a service of, say, job work is a service. In earlier service tax regulation, job work was considered as a service. So someone who is doing activity of painting on some sort of inputs, painting is a service, if you can say, though it involves application of materials and etc. Such kind of things or activities can be covered under manufacturing, definition of manufacturing, as far as mover scheme is concerned. Because government has kept the scope of mover scheme bit wider by including manufacturing and other activities in its definition. So other activities can relate it to all these job work related small activities, which are in turn supporting the main manufacturing activity. So someone who is doing these kind of job work activities, he can register under the scheme and import his tools or capital goods or machines that he requires for doing such activity under this scheme. Even more units can also do job work for other units. That is also feasible and allowed.
Okay. And so the question is, I guess you already covered, but documents are required for MSME to obtain scheme approval.
Okay. So, like we explained, sir, key documents we had considered explained, sir. Solvency certificate, it is issued by your banker in the name of Commissioner of Customs. Then there is one insurance we have to give from the any insurance for custom duty package policy, fire safety audit reports, then whatever your partner details, profile, director details, PAN, Aadhaar, GST. Since we have to appoint one person as a warehouse keeper, we have to furnish his PAN, Aadhaar card, and digital signature. Pro forma invoices of the goods that you want to bring in the scheme, be it if it's a raw material or capital goods, whatever is their value and everything. Then we have to furnish certain undertakings under the Customs Act to assure the department that we will follow all the regulations and the rules related to this scheme and any other scheme or any other rules related to bonded warehousing or the private custom bonded warehouse, and we will furnish the reports time to time. We'll pay the duties as and when required. So these kind of there are 3-4 undertakings that we have to give. Standard format is there. We also have to execute one bond. So all this set of documents is there. But major documents, like I explained, solvency, insurance, fire safety audit report, and site plan. Other things are generally available to everybody.
And the bank guarantee, any security deposit?
There is no bank guarantee requirements under this scheme. Only solvency certificate is required. So solvency certificate is generally issued by the bank based on the net worth of the company. So if my company has a net worth of, say, net worth is basically your assets minus liability. So whatever is your net worth appearing in your balance sheet, based on that, banks issue the solvency certificate. The bank does not have or does not take the liability that if tomorrow the company is not paying the input duty, government cannot recover this duty from the bank. Bank is only giving the character certificate कि भाई so and so party is my client, he has been a good client for so and so years, and in our opinion he is good for so and so amount or solvent up to so and so amount. But government cannot recover this from the bank. So for getting this certificate, there is no requirement of doing any fixed deposit with the bank or blocking any funds. The entire purpose of mover scheme is to uh, make working capital available to you. So
Yeah.
if the funds get blocked in the fixed deposit with the bank, then that doesn't solve the purpose of the scheme.
Right. And so what are the penalties for non-compliance, if any, under this scheme?
So there are no specific penalties which are prescribed under the scheme, sir. But general penalties related to non-compliance could be 10,000, 25,000, 50,000, depend on the nature of non-compliance, because these are not, these are kind of depending on the officer who is levying the penalty and the nature of the non-compliance. But generally, we have seen since we are working in this scheme last 4 or 5 years, we have not seen anyone impose any penalties on any units just for some basic non-compliance like late submission of returns or non-maintenance of bond register or non-furnishing of renewed solvency certificate. Since we have to furnish this every year, or insurance, they just send a reminder. We are submitting the documents as and when we are reminded to, and based on that, the good things are getting sorted out. Because the scheme, as we said, is relatively new. Government wants to promote it. If they start taking action under this scheme for small things, then that will not make the scheme popular for many. Because anyhow, this scheme is not that popular. Not many people are
Mhm.
aware of this scheme. Since even though the scheme has been operational since 1970s and even last 6 years since 2019, but still many people are not aware of this scheme. So by
Oh,
doing this kind of things, this will only increase the complications for normal people.
right. Gotcha.
Yes.
I guess you already covered this, but just this is a question: can MSME claim export incentives like RTDP, MES while operating under this scheme?
No, sir, because if you are registering under this scheme, whatever products are exported from a bonded manufacturing unit are not eligible by virtue of this specific exclusion from the ROTTEP notification or the scheme. So the ROTTEP exclusions from the ROTTEP scheme specifically mentions that any goods which are partly or fully manufactured in a bonded manufacturing unit or Section 65 unit are not eligible. So even though you had not imported the raw material under this scheme, only imported capital goods, you have sourced your entire raw material domestically, but still whatever goods you have manufactured and exported from the mower unit, you will not be eligible to claim the ROTTEP incentive just because
Oh,
you are in the mower.
right. So how does the scheme integrate with GST compliances for MSME?
So GST compliances are totally independent of this
Yeah.
scheme. So in this scheme, there is only one monthly return that we have to file. This is also a kind of Excel return. Format is given in Excel. We have to just fill in the details of
Mm.
whatever inputs duty free we have procured in that particular month. Out of those inputs, how many are issued to the production and lying at the production floor? How many are converted into FG and lying in my FG inventory? How many we have sold and paid the duties? Only this movement and these details we have to furnish this through this Excel sheet. If we are sending some material for job work, then the details of those job work. So there is no specific integration of this scheme with GST
Mm.
scheme, but there is no additional compliance also under GST because you are registered under this scheme.
Right. So is this scheme applicable for new entities since it's difficult to get insolvency certificate from bank
So
for the
like I
new entity?
explained, sir, the scheme is applicable for new entities also, and though they do face certain challenges in getting the solvency certificate,
Yeah.
but based on your relationship with the banker and your convincing power means I am saying ki, if the bank doesn't give me the solvency certificate, I still have the money to pay the duties. That's why I'm importing the goods.
Mm-hmm.
Ultimately, it's not dependent on कि only if I register under मोर scheme I am importing the capital goods. मशीन तो
Mm-hmm.
मैंने वैसे भी लाना है, ड्यूटी पे करके ही लाना है, अगर नहीं दूंगा
Mm-hmm.
पैसा तो हमारे पास आज भी है. It is
Right.
just you are mentioning in the solvency certificate that I do have that much amount Though it is because most of the companies have only 1 lakh rupees paid up capital, share capital. So based on the director's history, also banks issue this solvency certificate.
Sometimes they want operational for 6 months, 3 months for
They
the
can give
solvency.
kind of this also. Okay, this valid for only 3 months, 6 months. So based on that, we can get the registration and we can give an undertaking to customs. Okay, after 3 months, we'll submit a new certificate. Because ultimately we have to maintain that solvency with us. Generally, though there is no expiry date mentioned on any solvency, but still every year we have to submit this.
Yeah.
So if there is an expiry date mentioned, then we will have to comply according to that expiry date.
Right. This is the last question, sir. What are the key benefits, limitation of the bonded manufacturing scheme for MSME compared, compared to other schemes like EU, more or SCD you covered, I guess. Yeah.
So key benefit is, sir, you are getting ease of compliance, ease of operation, and only a regulation or monitoring by single authority compared to multiple monitoring by multiple authorities or submissions or reportings at a periodical renewals and compliance with export obligations, requirements of bank guarantees. So these all things are taken care under MOVER scheme. Specifically if talking, somebody who wants to set up an EO unit is a new entity without any export performance or any domestic sale or anything. It's a new entity. They still have to furnish a bank guarantee of 5% of their bond value to be eligible to import goods duty free. So if they want to import, say they're furnishing a bond of 5 CR, they have to block their 25 lakh rupees of worth capital in fixed deposit just to ensure to import those goods. Under MOVER scheme, there is no such requirement. So this is kind of an added advantage over these traditional schemes. But still, like I said, EOU scheme is still eligible for ROTTEB incentive, whereas MOVER scheme is not. EOU scheme is still eligible for you if your product has a BIS requirement at the time of import. You can import it under EOU scheme without complying with the BIS requirement because you have undertaken to export your entire output. So that is kind of an assurance to the customs that this imported goods will not go to the domestic market. But in MOVER scheme, you don't get this exemption from BIS. So somebody who is dealing in the goods which are notified for BIS and are subject to BIS registration at the time of import into India, they will still prefer going to an EOU scheme by taking this compliance burden rather than MOVER scheme because EOU scheme offers them exemption from BIS certification requirements. Whereas MOVER scheme, they will have to, even though they are importing the raw material for the export purpose only, the someone who is operating as a MOVER scheme, but still they will be required to furnish the BIS registration at the port of import because customs circular or they had issued some internal circular which says that only advance authorization imports under advance authorization and EOUs will be exempt from BIS registration and not any other scheme. So this is an advantage of those schemes over MOVER scheme. Whereas MOVER scheme has advantage in case of ease of compliance and everything. Plus ROTTEB incentive you get in EOU which is not available in MOVER. So it all depends on sir, what is the composition of your imported input in your final product. What is the rate of ROTTEB for which you are eligible? It also depends on how many your imports or imported inputs are subject to such registrations as BIS or everything. What is your production cycle? All these things we need to factor in before arriving to which scheme is suitable for you.
Yeah, you need to do due diligence.
Yes, sir. We need to do a proper diligence about what exactly my operations are going to be, how much component is my imported, what is the duty structure on my products. That also matters. Because if my duty structure is almost 40, 50, 60%, then my bond value will be higher. If my bond value is higher, so I will have to furnish a higher bank guarantee. So that will, so all these things we need to take care while deciding which scheme we should go for.
Right, so I guess this is a wonderful scheme, and you give fully, all detail possible in this webinar. And I guess people are not very aware, and your thoughts and your knowledge has been fantastic for us. And Raviji, that's question are all done. So we can wrap up.
Yes, sir. Yes, sure. We can wrap up with the vote of thanks.
Thank you, Shrikant sir.
Thank you, sir. It
Thanks
was
for your time. Thank you.
wonderful
Thank you,
addressing
sir.
this audience, sir. Thank you.
Thank you, sir. Thank you for wonderful session, sir.
Thank you.
Thank you. Thank you for coordinating the session, sir.
Thank you. Thanks.
Thank you, tech support team. Yes, sir.